What's up, everybody? Today we've got a new guest coming on talking about trust. Her name is April Mora. I've been deep in communication with her and her husband, especially over the last few months. We've known each other for the last few years, but really started working together here in the last few months. And, this is something that, in my opinion, everybody could benefit from, and especially for those of us that are in crypto or real estate. This is where we can really shelter our money so that we protect it from the degradation of taxes. And see, a lot of people, they just kind of shrug their shoulders and they just, okay, well, I got to pay Uncle Sam what I got to pay them. And there's really no two ways about it. And that couldn't be further from the truth. In fact, a lot of the laws in the United States were designed to protect you from the United States government from overtaxing you and from keeping the economy going, really. And so today, April is going to go really deep into this. Her and her husband go speaking throughout the United States to family offices, to investors, big whale investors. And I thought that it would be a really, really good live for us to have April on here and really run us through, okay, what is it that we can do to minimize our tax liability and also bring down, I'm assuming, April, our exposure against lawsuits and all these things that could really harm us and take years away from our lives. So without further ado, April, go ahead.
Wonderful. Thank you so much, Gven, for bringing me on today and being able to join you and talk through this with the attendees today. I'm going to kind of share my screen here, but a little bit about me. I have started in the mortgage business in 2003 and then expanded into financial strategies in 2007 when, I was doing everything right. I thought I was putting my money exactly where it needed to go. And then the invisible elephant came down, right? And everything fell apart. In the mortgage crisis, I was in the epicenter, account executive for a big bank. And, I made great money and then minimum wage, right? And how do we survive? How do we get through it? And found out that I had been putting all my money in the wrong places. So I went on a financial literacy mission, my husband and I, and really explored different strategies and brought the power back, right? And I think great power comes great responsibility. Once we have this information, it's really important to get this out to as many people as we can, disseminate this information so they can have the most education up front so they can make the best decisions, right, for them and their family. So through this financial literacy mission in 2007, expanded into financial strategies, and then in the past 3 years, more on the trust structure side of things, because there's only so much that we can work with when it's the money we have left over. Right, that net income. There's only so much that we can do, right? Make money on our money, put it in high value cash policies. There's only so much, but what are we doing with the other half? Did we know that we can hold on to that too? And then how much more power do we have, right? What legacy can we leave for our family? It's really about building generational wealth, but it's not how much money we make. It's how much money we keep, and it's how hard it's working for us, just like Kawasaki said. So it's bringing that, I think, that Wall Street to Main Street. This is not a new concept. It's really been around for generations, but I just truly feel that it just wasn't attainable for the middle class. It wasn't attainable for all of us just because, it's where the big boys played. And they don't want you playing in their sandbox, but guess what? We're going to go play in the sandbox with them. It's time. So I'm going to share my little screen here. Let me know.
By the way, everybody, take notes. I'm actually taking notes right now. I'm taking notes of this because I think that it's very, very important what April's about to talk about. Guys, gals, your tax liability is your highest overhead. Your highest overhead, individual item that you pay every single year. So if you can cut this down by any means, all right, legally, y'all should be taking notes. Y'all should be taking notes. All right, April.
Thank you. And do you see my screen? Is it showing the slides?
No, it's not.
Okay. Let me work on this for a moment, guys. Let me get that back. Anthony told me to do a little thing here. And select tab to share. Yes, right here. Okay, now I should be able to share.
There we go. All right, I'm going to jump off stage.
Wonderful. Wonderful. Thank you, Gven. So this is really about learning about the right structure, what works for you, and it's all surrounding a type of trust that we're going to describe today. The first thing is that there's so many different structures out there, and that's the most confusing part, right? You hear, oh, the Rockefeller Trust. Oh, own nothing, control everything. It seems like everybody's throwing out these little catchphrases. But then when you look inside and you look how the structure's set up, a lot of it's wonky. You find that it's a shell game. They're setting up multiple corporations, LLCs, multiple trust structures, trying to defer the tax, but they just don't have it exactly right. So we have to be careful about what's out there and really kick the tires and look under the hood. That's what I appreciate about working with Nexus International Business Advisors. Just like I've been with my husband Gavin for 15 years, I've known the principal of Nexus just as long as I've been with Gavin. Scott McGrath, he's a dear friend of ours. And Gavin has known him for over 20 years. We met in the mortgage business back then. And so it's important to understand who we're doing business with, but also with Scott, him being a certified financial planner, having all these things that he's been able to achieve. But the firm being 7 years old, it's in Dallas, Texas. That's our corporate office. What he was smart about doing is bringing the right people together. He researched and he got the right team. He has the enrolled agents, he has the CPAs, and he has the attorneys that can help you navigate through this journey. Any legal questions you have, any tax questions you have, having the team that can file the trust tax returns properly. This is very important because it's not just about how a trust is created, but it is how it is implemented with the appropriate contracts in your life, and then how it is operated. And so, having a team that can navigate through that journey is important. But it's also important to understand that a lot of our clients already have an attorney and CPA that they trust. And that's wonderful. We don't want to interrupt that team. We want to be part of that puzzle piece. You would just lean on our team on the trust structure side of things and still utilize your CPA for personal and business tax returns. So it's having that holistic approach and making sure that we're implementing this correctly. So just a little disclosure here. This presentation is not to constitute tax, financial, or legal advice. Do not assume that anything said here applies to your specific situation. This is just for informational purposes, but thank you for attending. So this is really where it starts, right? It's about own nothing, control everything. When we own something, it can be taken from us, right? Think about it. If we own something, we can get lawsuits, right? It can be taken, and we get taxed. So another rhyme to remember is the structure you choose dictates the tax code you use. And I'll dive into a little bit about what that means, but I didn't know that there were two sides of the tax code, and it's kind of a funky thing. Did you know that the two sides of the tax codes, the name of them, one's called simple and one's called complex? I mean, isn't that a joke? I mean, isn't the tax code just riddled with double negatives? I mean, it's meant to be confusing, but then they name one side simple. So we'll kind of go through that, what that means, what impact it has on your trust, what it means on your taxation, and go through that. But own nothing, control everything is really the epicenter of what this is all about. So this is John D. Rockefeller. He's famous for saying this. And what he did is he built these structures. He utilized these structures to defer the tax, right? And then he passed that baton on to his grandson, Nelson Rockefeller, who is famous for saying the same thing that Grandpa said. The success is about own nothing, control everything. So just remember, this is really where it begins. So with proper trust structure, these are the individuals that we see are most impacted in a positive way by using this. Property owners, right? You can defer the capital gains tax on property. But remember, property is not just limited to real estate. We kind of think, oh, well, it's property, it's real estate. No, property is also stocks. It's when you sell a business, and it's also your crypto, right? So before you sell and experience that tax on that gain, you can set up this trust structure first prior to that sale, defer those capital gains, and then use those proceeds to go buy more crypto. So your buying power is increased and you keep rolling it and rolling it. And you're not creating taxable events like a 1031 exchange. It's not like that. And 1031 exchanges are very limited, right? It only applies to the real estate side of things. So this will allow you to sit in the seat with more buying power and to achieve more. A second type of individual that benefits from this is the investor community, right? Investing in a business, right? Investing in an equity fund, right? You get that K1. Well, if you take the distribution, you get taxed. But what if you set up this trust structure first? What if you had this first and that trust became the limited partner in the equity fund? It could be a great way to defer that passive income, that K1 passive, and then go invest it in another business or go buy crypto. You don't have to reinvest it in the same asset that you're receiving money from. It gives you latitude and flexibility. And then finally, for the business owner, producing active income. Like, we're all business owners. We're, operating our businesses, maybe we're making money only on the passive side, right? You're just buying and selling crypto on the passive side. But I know quite a few individuals are not only making passive income with their crypto, maybe they have a business and they're getting paid in crypto. Well, that's active income. That's not passive. So also a thing to remember is when the company or the person is making the money, it's active income. So with this trust structure, we can help you defer a good chunk of it, 50, 70, in some cases, 90% or more. But with passive income is when the asset is making you money. If your asset is making money, so think of anything that you have, right? Real estate, stock, crypto, you're selling a business, your intellectual property, tangible and intangible, right? All of that has value. When you sell it, that's an asset, and all of that money that you bring in is passive. So we can help you defer up to 100% of the tax on passive income. So it's just understanding of where are you deriving your income from, and then we help you put the best structure in place to really build it out so it runs the most efficient. So it's really about getting these three benefits, right? Why you're going to go and get this structure, get this all in place is literally for these three benefits. To have asset protection, Gven was just explaining, asset protection, incredibly important. The bigger you get, the target gets bigger on our back. We're in a litigious society. Having asset protection, moving your assets, selling, not granting, and I'll go through that a little bit, selling your assets to a structure that you control, that you're the puppet master of. So nobody, if they sue you tomorrow after you have this trust structure in place, they cannot take things from you. So having asset protection, but also having control of those assets. There is a lot of structures out there that miss the boat. They do not have the right provisions in their trust structure. So they're trying to just shove a peg through a square hole. It doesn't work. So you need to make sure that all the provisions are interwoven into the fabric of the trust to truly give asset protection and asset control. There's some structures out there where they're like, okay, well, I'll give you all the asset protection, but you're going to have to give up the control of your asset and we'll manage it for you. That's bull. Nobody should be controlling and managing your assets for you. This is a private trust. It's for you, and it's nobody else's business to manage or know what you have. And then finally, tax control, which I think ultimately could be one of the strongest parts here, is having tax control, right? Deciding when you want to pay the tax and operating this. If you continue to operate this through your lifetime, and then your kids operate it through their lifetime, and then your grandkids operate it through their lifetime, you literally can continue this for generations. The longest trust, this type of trust structure that we found that is still in existence, is the Windsor Spendthrift Trust. It holds the Windsor Castle. It's been implemented and operated for over 400 years. So you truly can take control and, have so much for your family to truly build generational wealth. So I'm going to go through, just talk through a few stories. These are real clients, of course, different pictures to protect them. But these are real clients, their real scenarios, and how much money they were able to defer. But not only think about this when I'm going through these, capital gain on real estate, remember that this could be for crypto, right? It's any property in the eyes of the IRS. So this individual, he had a property here in the Bay Area in Cupertino. He purchased it 30 years ago for under $200,000. And now it's worth, at this time, it was worth 2.5 million. When you take a look at what kind of strategies are out there for someone that's held on to a property for 30 years, specifically as primary residence, there is absolutely nothing that will help him to defer that tax. If he wants to sell and buy something smaller, even a 1031 exchange doesn't work for him because you can't do that on a primary residence. So he would have been paying over $1 million to the IRS. Why is that? When this older gentleman has to pay $1 million to the IRS, when billionaires flip hotels and defer their capital gains. How is that possible? It's because they have strategies like this. So with proper trust structure, we were able to get the structure set up in time, amend his purchase contract to say that the seller was no longer his name, but it was his ABC Spendthrift Trust. That was the seller. And at close of escrow, the title company had the wiring instructions for his trust bank account that was at the bank that he normally banks at. So all that money came into the trust, all those capital gains came in, but the capital gains tax was deferred. So he has that full, this guy had maybe a $40,000 loan against his property. So all of that came into his trust bank account. So then he could use those proceeds to buy a smaller property. And then the rest of it, he could put into different accounts, non-qualified retirement accounts. He could buy stock. He can do what he wants to do with that money, but build that and leave that for the next generation if he chooses. Now, we've run into clients that their main objective is never sell during their lifetime, right? You have an older individual, has a couple of properties, and all they want to do is make sure that their heirs inherit their properties after they pass away. If that's the objective, then the living trust is perfect for them, right? So the living trust is great. But remember, the living trust only helps our family avoid probate, okay? The one that's setting it up absolutely has no benefits from it. They have to die in order to get the one benefit. It's kind of funny that they call it a living trust when it has no living benefits, right? So the trust that we're describing today actually has living benefits. So that's a good thing to remember, is if you're planning on never selling an asset during your lifetime, get a living trust. If you are planning on selling any asset or property during your lifetime, then start looking at something beefier like this that actually gives you tax control. So capital gain income from a sale of a business. We're seeing this left and right. Business owners, they will walk away from the closing table because the sticker shock of that capital gains tax is so immense. They just had no idea, right? But if we're able to educate them in time, get this trust structure set up, again, prior to close of escrow on that business, we can help that business owner defer the tax. So with this individual, she started a business of $50,000. It was a hospice care company. She sold her 25% of her shares to her remaining partner that was going to remain in the business that held the other 75%. She sold her shares. So what she was able to do is she was able to get the shares or the membership interest that she had in that LLC, sell it to a trust that she controls at cost basis. So at that $50,000 mark at cost basis, so she's not imposing a tax on herself. Then from there, the trust, right? They were amending the purchase, the PSA, saying that the ABC Spendthrift Trust is now the seller, right? The trust is the one that holds all the intellectual property. The trust is the one that holds all the asset of the business, right? The trust holds all the shares of the business owner. So when they go to sell their business, it's not them selling it, right? Remember, the structure you choose dictates the tax code you use, right? It's only in the structure that we're in is why we pay the tax we do. So shifting and tweaking, not interrupting how you're operating your business, but just adding 1 or 2 extra buckets to flow that money and flow those assets in properly prior to close of escrow can absolutely be a game changer. What do you think her tax would have been on $7 million? Right? She only had a $50,000 protection. So now she has that money. And since this time, she's already bought 3 properties, residential properties that she's converting into assisted living centers with the cash, with pre-tax money, because she reinvested it, right, in another asset. And on this Friday, she just called me yesterday, this Friday, she's closing escrow on another property. So it's a beautiful thing when you're able to work with so much more cash and not give it to Uncle Sam. Not saying that maybe one day, right, the IRS will get it, but you're not creating taxable events today. See, that's the issue with the 1031 exchange. You're using the 1031 tax code, right? That when you use a 1031 exchange, when you sell that property, when you engage and say, hey, government, I'm going to do a 1031, you're actually alerting them and you're creating the taxable event that day at close of escrow. You're creating it on that day. So then what does somebody do? They just continue to use the 1031 in this property and that one. And it just makes that snowball bigger and bigger and bigger. So one day Uncle Sam's going to come a knocking. This one, you're not even creating the taxable event. Why? Because we're using a different side of the tax code. And I'll explain that in a little bit here as well. But really, it's about having more money and being able to reinvest that into things that, again, are making you more money for the ultimate benefit of our beneficiaries. This business owner produces active income. Right? So we went through and talked about passive income, right? The last 2 slides were about capital gains, right? Because you're selling an asset. How about if the business owner is producing the income, right? He had a corporation. We can work with any type of statutory structure, whether that be an S Corp, a C Corp, or an LLC, LP. Some structures are better to work with the trust, but we can work with all. It's just we'll look at that scenario and we'll help you navigate through what you can and can't do and really identify how much tax can you defer. But for a C Corp or an S Corp, you can defer up to 70%. With an LLC, it could be up to 90%. With a dual trust structure, if somebody's implementing 2, which all business owners, if you're producing active income, you use 2 trusts. If you're only bringing in passive income, right? Remember, when the asset is making you money, then that you can just get away with using 1. So with the dual trust structure, he can actually defer up to 90%. So for his first year, he did a single trust structure. He deferred that 50 to 70%. And it did wonders, right? Instead of him producing $800,000, that's his net income, right? If he did not have this trust structure, and if he did not have this set up before the end of the tax year, right? Before December 31st, right? As long as this is structured and you've implemented the proper, contracts, and you've moved that money, right? Remember, you're only taxed on money you do not move. Must move the money. Move the money from your corporation into your trust structure. Now it's protected. Now it's deferred. Now whatever's left over in this scenario, the 50 to 30% that's left over, that net income, that's what you get taxed on, not the whole thing. So this can do amazing. And back to the LLC, maybe you're only paying tax on 10% and deferring the other 90. So again, a game changer. There's reasons why business owners next door to other business owners are expanding 3 times faster, because they have strategies that they can utilize to deploy more capital. What could you have with more working capital? You could hire that other employee. You can expand, you can do certain things. And so it just brings more power to you. So just don't think about this just as just the traditional active income. This is for your crypto too. If you're operating a business and getting paid as crypto, it's coming into your corporation or your LLC. On my crypto guys, forget the statutory entities. Forget the Corporate Transparency Act. Forget all of that stuff. You do not need to even be a statutory entity. There's no law that says you must have an LLC or corporation to operate a business. With the quicksand, right, that you experience with all the laws shifting and changing in crypto, it's hard to keep track. You get dizzy. What if you just took yourself completely out of the statutory space and you just ran your life with a dual trust structure? They're non-statutory, and I'll get into that and what that means. But that top trust, that trust acts in lieu of a corporation or LLC. It can have 100 DBAs. It can have 100 bank accounts. You can operate in a non-statutory space. It is above legislative control. It's built in contract law. So again, it just gives you more power. And in that case, if you're doing a dual trust structure, you can defer up to 97% of your net income. So we've been talking about investors. So this is anything that you're investing in, right? It can be you're invested in a business, or you're investing in an equity fund. Whatever you're investing in, this specific individual, he liked to invest. He was a business owner, but he also had 3 investment accounts spread out, all real estate equity funds. And 100,000 here, 100,000 here. This is his $250,000 investment that he made into an LLC, right? He was the limited partner with $250,000 capital. And, he, excuse me, what he chose to do is, once he got his trust structure set up, not only was he deferring his tax on his LLCs, but he was also deferring the tax on his investments. So in this case, instead of taking that K-1 distribution and paying the tax, right, as a limited partner, instead of it being him, he changed the account. He just called up, right, the equity fund. He's like, hey, I don't want it to be my name anymore. The account holder, can I change this to my ABC Spendthrift Trust? I want them to be the account holder. No problem. He paid a little fee, changed it over. And now that money up to it's 90% can be deferred and pay it out as K-1 passive. So he's deferring 90% of that, the distribution in his favor. And then he can deploy that and put it in something else. So 8 essential components. So it's most, and I have this, sorry, my little wrong there. There are 8 essential components. I'm going to add to this a little bit. We'll just go over the 6. The other 2 is that it's non-self-settling and it's private. They'll interchange with the ones that I'm talking about here, so it wasn't necessary to kind of dive into those. But number 1, non-statutory. It's also non-grantor, irrevocable, dual track, discretionary, and it has a spendthrift provision. So let's just dive into what these mean. I know it's a lot of jargon, a lot of legal stuff. That's okay. I just want to build the framework and for you to understand that it's super, super important when you're looking at different trust structures that the trust itself has all of these provisions, because all of these provisions that we're describing here is why you will have the asset protection, asset control, and tax control. If you're missing one of these, you don't have the right structure. There are reasons why there are other firms out there don't have attorneys. There's a lot of bad actors. You might see an IRS memo floating around and kind of an open email between attorneys. They're cracking down because there's bad actors just putting something out there, selling a really expensive trust book, but not doing it right, not setting up the trust right, and not having the attorneys and CPAs and enrolled agents backing them up. So just be careful about the things that you see out there. So first of all, this is non-statutory. And I know I described that a little bit earlier. Non-statutory. It means that this trust is based on contract law, right? We have the right to contract. It's in our Constitution. It is imperative, excuse me, that we have the right to contract. This trust is not a creature of the state. It is above legislative control. Contract law was around prior to statutory law, right? Statutory is anything that's in the state, right? Like your LLCs, your C Corps. That's why you have to go to the Secretary of State to form it. Then that means that they oversee it. Corporate Transparency Act, reasons why anybody over 20% ownership in a statutory entity must disclose who they are. You have to give them your driver's license, your social security number. I mean, there is no veil, right, of privacy anymore. So with non-statutory, this does not have to abide by the Corporate Transparency Act. This is above the Corporate Transparency Act. So something to be aware of, and you'll have a lot more control using a non-statutory trust, and I'll explain that in a moment. It's also important that you have a non-grantor and non-self-settling trust, okay? And they're kind of interchangeable. A non-grantor trust means when you look at any trust structure, there are 3 roles, if not more, but there's at least 3 roles in any type of trust you get, whether it be statutory, non-statutory. That trust has 3 roles. It has the grantor, the one that creates the trust. Another word is settler. You have the trustee, the one that moves and manages the assets. And you have the beneficiary, the one that ultimately benefits. So these are the 3 roles. What you'll find, similar, we'll kind of pick on the living trust for a moment. The living trust, if anybody has a living trust on this call today, I guarantee you 99% of the time, you are both the grantor, you're the one that created the trust, and you're also the trustee. Or you're the grantor and also the beneficiary. You're acting in 2 roles. That's called an alter ego trust. You just got rid of all your asset protection. It's kind of like operating an LLC and you're the only member, right? It's a disregarded entity. It's the same thing. You don't have that protection. You created a trust for ultimate benefit of you, right? And so when you're called in, when there is a lawsuit, opposing counsel can simply say, look, judge, he set up a trust. It's an alter ego trust, and they can take those assets from you. It's also important that this is non-self-settling trust. Non-self-settling means that, so on the non-grantor side, our clients are always the trustee. You will always move and manage your own assets, and you will name your beneficiaries, typically your children, nieces, nephews, parents, whoever you want to name as your beneficiaries, but you are not going to be the grantor, right? You're not going to be the grantor. So non-self-settling means the client is not the grantor. You are not going to settle. You are not going to create your own trust, right? Non-grantor means that the one that is sitting in there, like sometimes I'm the grantor for my client's trust, maybe it's your best friend because they're going to have nothing to do with your trust. They're never going to be a beneficiary, right? You just want to be very, very careful. It's just somebody that you know and trust, but somebody that's going to sit in a notary appointment for 15 minutes, create your trust, appoint you as a trustee, and then resign. Okay. Non-grantor means that the grantor resigned. There is a notarized resignation letter that goes inside that trust book. So if a lawsuit ever does occur after you've created your trust properly, after you've legitimately, with the right contracts, sold your assets to the trust that you control, who is a separate legal entity than you, it files its own federal tax return, it has its own EIN number. It is not you. Remember, own nothing, control everything. So when that lawsuit comes knocking, and when the judge sees your type of trust in his closed chambers, because that's the only place he's allowed to see your trust book because it's a private, non-statutory trust, you have legitimately sold those assets prior to the lawsuit date, and that grantor has resigned. There is no one to be called on to pierce that trust. And you are simply a trustee moving and managing assets of a trust you did not create. That's asset protection. Irrevocable is important as well. Some of our clients get a little squeamish when they hear the word irrevocable. They're like, oh man, darn it. That means that once it's there, I can never change anything. I don't have control. I hear that so much interchangeably. Irrevocable, I have no control. Absolutely incorrect. Irrevocable simply means that if you as a person sold your house to your trust that you now control, it means that that specific asset cannot revert back to personal ownership to you. But it does not mean that you're not over here as the trustee, being the puppet master, reaping rental income deferred, reaping capital gains deferred when you sell the property. Whatever you'd like to do, you're still in control. Dual track. So remember how we were talking about non-statutory versus statutory? And we were talking about simple versus complex. This may make a little bit more sense now, describing it this way. Statutory must use the simple tax code. Non-statutory allows you to use both sides of the tax code. If you have a statutory trust, which so many people do, you're in the statutory space, you're within legislative control, you are required to only use one side of the tax code. Short way to remember it is the simple tax code means you must distribute. Simple tax code means you will pay tax annually, okay? You're forcing a taxable event on yourself because you're required to distribute. With our trust, because it's non-statutory, it allows you, it has a dual track provision, which means that you are up to the discretion of the trustee to treat your trust as simple or complex, depending on what you're trying to achieve. So our clients that have a one trust structure, right? Remember those that are just bringing passive income, that are reaping just passive income. They just have that one trust. It's going to use the complex tax code. Remember that billionaires flipping hotels and deferring their capital gains tax, right? They're using the complex tax code. They're not required to distribute. That's how you can keep all this money snowballing for generations. A business owner is going to use two trusts. This trust on the top that's bringing in their active income, right? Deferring their income is always going to use the simple tax code because why? It's going to distribute. Where is it going to distribute? Into your complex trust. So it just allows for the structure to work. And then finally, the spendthrift provision, which has to be one of the most powerful provisions in the trust. It means no judge or court may issue a turnover order on assets legitimately sold to a trust prior to lawsuits, prior to creditor judgments, prior to IRS judgments, franchise tax board judgments, whatever it is, any money that's owed, if you have sold the asset in question to the trust prior to any knowledge of these things happening, your assets are protected. So we went through this, and I won't go through it too much, but active income versus passive income, right? Remember, when the company or when the company or the person is making the money, that's active. We could defer it by 50, 70, in some cases 90% or more. When the asset is making you money, that's passive. We can defer 100%. So again, just looking at where you're pulling that money from. So these are the 6 types of passive income. You have capital gains income, rental income, dividend income, interest income, royalty, and K1 passive. We've described some of these in the story, so just want to share that all 6 types of these passive incomes can be deferred. This is the tax code that we utilize. Mainly, there's other tax codes that are part of this, but this is the main one, Section 643. I'm just going to read the bold and kind of decrypt it for you a little bit. So items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary acting in good faith determines to be allocable to corpus under the terms of the governing instrument and applicable local law, shall not be considered income. So what does this mean? Well, items of gross income constituting extraordinary dividends or taxable stock dividends are these, right? These 6 types of passive income, which the fiduciary, which is the trustee, acting in good faith, right? You're doing everything by the book, determines to be allocable to corpus. Remember, it's up to the discretion of the trustee to treat his trust as complex or simple. You determine if you're going to allocate it to corpus. Corpus is the Latin word for body. It's talking about your body of your trust, where you hold all your assets under the terms of the governing instrument. So you see the phrase governing instrument sprinkled through the tax code. What they're referring to is your trust contract. If your trust allows you to do it, the IRS is going to abide by that contract. It's the only place in the tax code that the IRS will abide by what you've written or our attorneys have written for you. So that governing instrument, that's why it's above statutory, it's above legislative control, because your contract is the governing instrument. And applicable local law shall not be considered income. This is not income until you distribute. We teach you not to distribute. So these are some companies. There's some that have fallen off, a lot more that have been added. These are companies that pay little to no federal income tax. It's been, I think it's close to half of the Fortune 500 companies pay little to no federal income tax. Why is that? I mean, they have a lot of different strategies at their fingertips. And I'm sure they have firms that are swooning over them. But just because we don't have that many zeros behind our names doesn't mean that we shouldn't have the tax strategies that the big boys deploy. So, again, you navigating through this, understanding what your objectives are and how we can defer that tax, it could be a game changer. So our trust is grounded in law. This trust is written to comply with the 8 different trust law categories and governing laws and codes. We have an executive summary that we can disseminate. I'll get that over to Gven. That we can disseminate. It'll give you more of the details of the provisions we talked through, the tax codes, the case law, and all of the trust law categories. If you want to take a deeper dive, I like to draw pictures. I'm the big picture person, but I know there's some analyticals that like to read every word. So we have it in all different ways to get that information to you. Our trust is guaranteed to be compliant and consistent with the U.S. Constitution, U.S. Supreme Court, and other case law decisions, and it conforms with all contract, trust, and tax laws in all 50 states. This is a pretty cool statistic. Of complex spendthrift trust, it's a short name for today's, if you really want to name the trust properly, you need to list really those, it's 8 provisions, but you need to list those 8 provisions in order to have, this type of trust. U.S. tax court is where most tax cases are heard by judge or jury. There are less than 300 cases on record that have been heard since 1992 until today. And approximately only 75% of those cases had anything to do with trusts. But look at that. 100% of those cases heard were about revocable grantor trusts. What are those? Those are your living trusts. You created your trust. You were the grantor. And it's revocable. You can hop in, hop out whenever you deem. There's a lot of trust tax schemes that can happen with those. That's why having those protections for the asset protection, asset control, and tax control are super important. So with this, there are 0 cases found involving our trust. And I know we shared a lot of information today. I'll kind of turn it over, but this is just a journey, kind of a timeline on what you could experience. But just going through, kind of doing a one-on-one Q&A session. You can ask some questions. We can whiteboard some strategies out, see how this can meet your objectives. Complete an intake form. We prepare your EIN number, prepare your trust book, get it delivered, help you activate it for your first notary appointment, advise you on the typical trust bank accounts of where you would go, get a tax strategy session with the bookkeeper, with the CPA or enrolled agent. If you need bookkeeping services, that's available as well. After that strategy session with the enrolled agent, you would then understand what type of assets you can sell, which ones you would keep out. For instance, IRAs and 401ks, right? You've already made a partnership with the IRS. You keep those ones out, but you could put everything in. And once you've established all of this, you truly have the benefit of the Spendthrift Trust for life and for your heirs. So I'll leave it open for some Q&A, and you could take it over, Gven. And let me stop sharing here. Oh, I don't hear anything.
Oh, there we go. Sorry, I was muted.
Thank you. I'm glad it wasn't me. I'm like, I don't know what to do.
So we have a few questions, but for those of you that are interested in booking a call with April, you can do that. There's some really complex questions here especially from Thomas, and I know Thomas knows his stuff he's been taught a certain way in regards to trust. So I'm going to say, Thomas, this is more for the beginning person, but if you want to book a call with April, I would highly recommend it. So let's see here. So one of the main questions, April, and this is something that's always been on the back of my mind, is, at what point in time do you start thinking like, I need to set up a trust? Like, is there a threshold of, what my net worth is or what my income is, where I'm like, okay, I gotta start thinking about this before the IRS comes creeping on me?
Yeah, a good question. So it's really not about net worth, but more about what is your tax exposure. So 2 things, have you amassed a lot of assets where you just need asset protection, right? You're a big boy out there. You're, people litigious, right? Everybody's suing everybody. So if you have a lot of assets, right, this is the best asset protection. So that's number 1 kind of qualifier. Or if you just know that as a business owner, you're going to pay more than $30,000, in tax, it may be time to look at this so you can stop the bleeding. But then it's more about when you're going to have a taxable event. So for the business owner, if you've kind of done the math and you're like, oh man, my tax bill is going to be like 30, 40,000 this year. Shoot, I need to hurry up and get this set up before the end of the tax year. So as long as you do it by December 31st. The other thing is if you're selling an asset, right, whether it be crypto, a business, a property, real estate, you want to make sure that you get this set up prior to you closing escrow, right? So it's kind of a timing thing to remember, but then also how much tax are you going to pay? Again, if it's $30,000 or more, definitely take a look at this because you're paying at one time and then you have a whole service team behind you for 5 years to help you through it.
Yeah, and I'll tell you all this. So like when I kind of got introduced to these tax structure things, there was a whole bunch of groups going around talking about this stuff. And, it was so funny because it was so complex. It was so complex. And it was like, it was like an algebra 2 trig question, you know, like, oh, well, here's where you start with this, and then it drips down to here, and then it drips down to here, and then you got to lend it back to this one, but then it drips down to here. And I'm like, how many
schematics are ridiculous, right? They're so detailed. I'm like, what are they doing?
What are they doing? Like, do you, and you know, I've heard a few people have gotten in trouble for these things in the past few years, because like you said, there's been a lot of these kind of scammers popping up, charging all sorts of money. And the thing doesn't even make sense, and it's not simple. And I think the thing that I liked most about you guys' strategy, one, you guys have a team of lawyers, CPAs working with you, okay, and financial planners. But also, it's simple. It's a simple strategy, you know. And I think, like, given my strategy was like one or two levels, that was it, right? And it was just like, no, it's you have this and then this, and it was very, very simple. And I'm like, oh my gosh, why is it that people are trying to make this thing so complex? You know, go
Right.
ahead.
Right. And you know why? It's because they're operating in the statutory space. It's a statutory trust, even though they're saying it's non-statutory. It's a grantor trust, you know, that's a non-grantor, but then, you know, they make you the grantor, or just by your actions, right, of you depositing money straight from your account, setting it up. So it's just, again, that statutory space. You see all this craziness because they're trying to avoid the tax, but they end up evading tax because they're not using the structure properly. They're just shell game, hiding, keep hiding. No, put a contract in place. If you're an LLC, make a limited partnership and, you know, agreement, move that money. If you're a corporation, make your business trust a management service organization and move that money. It's a contract. Nobody can step between that. Yeah.
That's awesome. So Titus asks on YouTube, he said, how do I take advantage deferring taxation on selling my house with my soon-to-be ex-wife? She agrees on splitting the profits, which will be at least $30,000. Can I benefit from creating a trust?
Yes. Yes. So, you know, when we have divorces or splits with business partners, you know, whatever it is, you would benefit from this. So yeah, we could definitely see what the best structure. There's about 3 different ways to go about that, but you can absolutely, you know, split those proceeds in a tax deferred state. You know, maybe she just takes hers, she doesn't want to do a trust, and have her on her way, and she pays her tax on her portion, but you can at least defer the tax on your portion. So yeah, we could definitely talk through that.
Nice. Let me see here. I need a trust to dictate exactly when, how, and what my daughters must do in order to receive periodic payouts. Very structured, so they can't blow the money in a year like so many I have witnessed. Is that something that you guys also work on as well?
Yes. Yes. So this is a spendthrift trust, which means, you know, just like a non-grantor trust, remember how it separates the grantor from the trust, right? As they have nothing to do with it. The spendthrift provision actually separates your beneficiaries. It kind of puts a block there. So if, you know, beneficiaries, maybe we have some irresponsible child and they have a bunch of creditors after them, right? And so they cannot come in and pierce the trust and take all those assets. So you have protection there, but you can set it up exactly that way, right? You know, pass the baton on to a trustee that's responsible, and then have your beneficiaries get their timely things. But yeah, this trust can definitely help you with that too.
Awesome. By the way, if you guys are on YouTube, we're streaming this on YouTube Live. Head over there. We're trying to get our subscribers up. Hit that follow button. Hit the like button if you like what you're seeing there. Okay. And then also hit the notification button so that you know when we get on live, because we do get on live very, very frequently. Charity has a really, really good question here. If a person is just receiving their retirement income that they received from their 401k, what type of trust should they set up?
So if you're receiving retirement income from a qualified plan, which that is, right? 401ks, IRAs, you've made the partnership with the IRS, right? You saved in a vehicle that they control, and you've deferred the tax. But in that case, you would leave this asset out you would reap your money. But as you get that money, you're paying ordinary income tax on that. So you never want to put that into a trust. So I mean, if you're just bringing in if you're bringing in retirement income from there, but if you have other sources of income, like passive income, rental income, or if you're going to sell an asset, then this trust would be beneficial at that time.
Okay. Awesome.
The living
So,
trust would be good to start.
okay. So we have one of my amazing students. Her name's Judy. She's 79 years old and learning DeFi, by the way, guys and gals. So if you don't think you can learn DeFi or crypto, Judy is learning how to become her own bank. All right.
Awesome.
So Anthony, by the way, we have a special going on right now. It's $97 per month. Usually it's $197 per month. All right. But we're giving you, or $194 per month. We're giving you 50% off with the code. If you guys are interested in learning DeFi and learning how to build generational wealth. So one day you'll be able to use April. Head over there. It's $97 per month. You literally have nothing to lose. There's 30-day money back guarantee, and you can cancel anytime. All right. So Judy asked, per my statement above, I'm 79 years old, have not filed taxes since 2016. My nephew is my only heir. Will a trust protect him? I'm in ARC for 4 months and just starting to realize gains now.
Okay. So it's a good question. It's really just going to be about a timing thing, right? So when you start selling off your crypto, right, before you do that and you see those gains sitting there and you know when you're going to sell, there's gains. This trust is about you and your life today. Yes, it is for ultimate benefit of your heirs, but this is to give you control today so you reap more to work with for your crypto, right? So if you find that gain is right, you're going to pay more than $30,000 in tax, right? It is more important to set this up. But if you plan on maybe just holding that, right, with Gven's techniques where you're kind of just holding that and you're not realizing that gain, which he has some amazing strategies there, then, and you're just holding it in a coffer, and you're not going to realize the gain, but you're going to, pass that on to the next generation, right? So it would just mean needing to look at the timing on when it makes sense, but ultimately this would benefit, your heir.
Nice. Let's see here if we have some other questions here. If there is any really clear about information imparted here is that the tax system is not designed for the benefit of the people. We are intentionally uninformed of this information. It's true. It's true. Let's see here. Bradley says, I have 2 new LLCs and 1 S Corp, plus started on my ARC journey and have a job. Haven't started making any crazy money from investments, but I assume to grow. Would you recommend starting a trust now?
Yeah, sometimes it makes sense to be ahead of it, right? We can definitely do a one-on-one and kind of flesh through that and of the timing, what's going on. But yeah, those LLCs, if you start ramping up and you start producing some active income, before the end of the tax year, it may be a great way to shelter those tax deferred dollars prior to the end of that tax year, or when you start reaping a lot on that passive income before you sell that crypto. You want to make sure you get this trust structure set up. So yeah, I have business owners and property owners set up these trusts before the gain, or a long time before the gain. It just needs to make sense, on that side. But yeah, with the LLCs, it works great. Now, one thing I want to just throw out there when you're talking about different statutory entities, LLCs are easy. They're the most easiest ones to work with. Taxed as an LLC, right? They're an LLC taxed as an LLC. Corporations are the second easiest. But when you have an S Corp, that means that you had an LLC, but you have elected to be taxed as an S Corp. It actually gives you, and it ties your hands a little bit on if you can sell, if you hold assets in that S Corp, like real estate, which is the worst thing to do. But if you hold any type of property, even your intellectual property, if you want to protect your shares, right? If your S Corp ever gets sued, you never want to sell any asset out of an existing S corp because you may be creating unwanted taxable events. You'll sit with our tax strategists, our enrolled agents, to help you navigate through that. And there's some the strategies, revoking S corp and just using the underlying entity, right? So we can talk through that, as well. But yes, with all those structures that you described, the trust structure could definitely help you defer.
Nice. Anthony, throw April's link back up there, if you wouldn't mind. For those of you that are interested in potentially setting up a trust and really doing it right with some pros who really know what they're doing. Again, April and her husband, Gavin, they've been doing this for a long time. In my opinion, they do it by the book. They do it really, really well. It's not kind of like this multi-level marketing referral type programs. They're just a good old fashioned business trying to help people minimize their tax liability. And I would highly recommend booking a call. I think, and it's kind of hard, April. It's just like when people get on with us, you're not going to cure everybody's symptoms with the same medicine, right?
That's right.
So it's good to book a call and ask April these questions if you're serious, about setting up a trust. I know I haven't worked that into my strategy yet because I'm out of the US, but I am going to work it into my strategy this year. And the market's been in a bear market, so I've been taking all of my losses and writing those off as much as I can. But this year I anticipate making way more money, and I want to be able to set up these structures correctly so that, if the tax man comes knocking on my door, I go, hey, look, this was done by the pros. It was done correctly. I don't owe you no money so that you and Nancy Pelosi can go spend it on, Ukraine or more military defense. No, thank you. No, thank you. So yeah, let's see here. Is there a fee for a schedule appointment call with April?
No,
it's free.
All consultations are free. Absolutely.
Yeah. So you got nothing to lose. And like I said, she really knows what she's doing. She's going to be on a tour like Taylor Swift, except for trust. She's the Taylor Swift of trust, everybody. All right. The Taylor Swift of trust. So give her a call if you want to see her perform live for you, because she's going to blow your minds when it comes to this trust stuff. But cool. One last thing. Again, head over to YouTube. It's gvensariol.arc. My first name, last name .arc. Give us a follow. We're going to keep bringing you all some really, really good alpha. Next week, I have a very, very good live coming up. It's just going to be me, but the information that I'm bringing is going to be hot. Book that call with April. Get in with her, and give us a like and subscribe, because we want to keep bringing this good information to y'all. April, anything you want to close with?
I think we are good. I appreciate all of your time, and there is so much that you can do with this strategy, but it's really about meeting you where you're at and making sure that you're achieving your goals. We just need to make sure that we set it up right, and we have the team to help you support you. So I appreciate the time. Thank you, Gven.
Awesome. All right, cool. See you guys later.
Cheers.